Good morning, Sampatji. Am I audible and visible clearly?
Good morning, Dr. Raju. You are clearly visible and audible.
Thank you, Ji. Very good morning, friends. At the outset, let me welcome each and every one of you for Fast Track webinar series for IBBI Valuation exam exclusively for securities and financial assets. We are in batch number 17, day 5. And based on your request, tomorrow there will be one more session, and I have exclusively created a link for that. And those of you who are interested, you can post your request in the blog. And yesterday's and today's material also will be uploaded in the blog. And I have uploaded up to yesterday. Some content also I have actually given. So please share your request here. I will post the link in the blog itself. So you can go there and download the link, maybe click the link and then register for the day number 6. Okay, for a special session. Good. Now coming to topic today, it's on fixed income securities, which will carry a minimum of 7 marks, and possibly there can also be a minimum 6-mark case study or a maximum 8-mark case study also. So minimum 13 marks to 15 marks you will be expecting from this. I want to make one observation before I go into this. There are good, I will say, material on this. This is one such site. Please look at this particular site. Yes. This is a site on FIMDA. This is a Fixed Income Money Market and Derivative Association of India. So here they have frequently asked questions on the fixed income securities. So very, very important questions alone they have discussed. So kindly go through these FAQ. I think this will be a desified FAQ. So one of the important collection of information, and you can also connect with your exam questions, because many of these FAQs are connected with your exam questions for 1 mark. So therefore, don't miss this. I have given the link here. Okay, you can click this directly. It will take you to that link. Now, what is the fixed income security? So you have various avatars. So it can be maybe a very simple fixed income security. You can call it as a fixed deposit. Okay. So starting from a fixed deposit will have a fixed returns. Okay. So fixed income. So maybe another avatar is your debenture, bond. You can go on and government securities, corporation deposits, so company deposits. You can go on. So this is a very big subject, and there will be a life, generally infinity or perpetual bond or a perpetual debenture may be a theoretical concept, but practically you don't have such a bond or a debenture which will be perpetual. So practically speaking, all debt instruments, okay, all debt instruments, fixed deposit, it will have a maturity period. Bond, it will have a maturity period. Debenture, it will have a maturity period. And there will be a investment amount, there will be a redemption amount. So we call it as a price at which you will invest. So price of the bond or price of the debenture. So there are certain terminologies I'll be discussing slowly, okay, and I'll introduce certain concepts also, arithmetic, all these things slowly one by one I'll try to introduce. Now, let us first understand who regulates this debt market. Okay, so this is a fixed income securities, we can call it as a debt market, and you have in our country a market called WDM. Okay, it is a wholesale debt market. Okay. A very big market. So this is the wholesale debt market. Now look at this. BSC wholesale debt market, NSE wholesale debt market. It's a very big market. Okay. And if you look at this market, look at the turnover, per day turnover. It is all 182-day T-bill, Government of India bonds, Maharashtra bonds, so Madhya Pradesh bonds. So all these are, these are all the top GSEC reported NDS RST platforms. See, look at this. So where the volatility will be very less, it will not go up and down because you know the maturity price, you know what is the per annum or periodical return. So therefore, the volatility will be very less, but we'll say secured because it is backed by government sovereign bonds, and liquidity will be there. So liquidity, safety makes this particular market the most, I will say, the biggest market in our country. Big. So if you say no, share market, NSE, BSE market, वो तो छोटा है, very small compared to this. So for example, a wholesale debt market, you can add all this turnover. It will come to, look at this. It's a 3 lakh crore. Okay, 3 lakh in crores. Okay, so turnover in lakhs. Okay, this is in lakhs. So this much lakhs. So actually, per day turnover, it can go a minimum of, we can say, 3 lakh crore to 8 lakh crore. But stock market will be only 1/100th of that. Okay, so it cannot be can even be in 80,000 crore. So 8,000 crore to 10,000 crore. That will be the size of an Indian stock market, for your information. So with that in mind, let me take you to the first question. I just want to give you the connect. Please look at this. Who regulates? Look at who regulates the second debt market? Reserve Bank of India. So you have all the questions. You ask any questions about GSEC. I mean, you ask about wholesale debt market in India, you have an answer here. Okay. So Reserve Bank of India only regulates. So it is 1B. Now, who regulates capital market? It is SEBI. So who regulates the insolvency and the valuation profession? So it's IBBI. So who regulates the retirement funds, like a provident fund, the funds? So it is PFRDA. So please be careful about these kind of questions. So the same question can be asked in a multiple model. Okay, good. So now let me go to the concept called yield. Now, what do you mean by yield? So there are two people in here. One is the issuer. So issuer is the company. Generally, in a debt market, company will be maybe the percentage of in the wholesale debt market, corporates will be only 2% or 3%. So the 90% and above, 95% and above players will be only financial institutions. Who are financial institutions? Banks, okay, asset management companies, mutual funds. They have huge money. Okay, so almost the size of, so what is the size of a mutual fund industry? Okay, so mutual fund in India, the size of mutual fund in India. Look at this size, 40 lakh crore. My God. Now, where is this money kept? Okay, this money is kept in various places. Okay, so like for example, part will be parked in share market, part will be there, majority will be there in debt market, because that is where the, so if you have a debt mutual fund, so they will only invest in debt market. So they will not invest in, so we have the various schemes, various types of portfolios of market, mutual funds. So an investor will get return. So the return is actually measured in terms of percentage. And in wholesale debt market, we call that as yield. Okay, we call that as yield. And this is the cost to the issuer. So what is cost to the issuer? Cost of capital. We can call it as cost of capital or cost of debt. So cost of debt to the issuer, yield to the investor. So it is actually price of the bond or price of the debenture, price of the debt instrument. Okay, so the price of the debt instrument will be paid at the time of investment, and it is received by the issuer at the time of issuing. So he issues the instrument, they subscribe to the instrument, and there will be a redemption price. So maybe 5 years, 10 years later, it will be redeemed. So it will be paid by the issuer and it will be received. So please understand this fundamental. The yield return is derived by the investor and purchase of an investment is calculated by dividing the coupon rate. Coupon is actually the interest rate. We call it as an interest rate. So the coupon divided by the purchase price. This coupon divided purchase price is called the current yield. And there are slight difference between this yield to YTM, current yield, and yield to call. All this I'll be discussing this with respect to some case studies, some examples, some arithmetic. Okay, so it is called current yield. Current yield means current year, and yield till maturity means, for example, the life of the bond will be 7 years. For the entire 7 years, you find what is the yield to maturity. And yield to maturity, it will not be 7-year return. It will be annualized return only. But I consider the entire 7-year period. But what is current yield? I will only consider 1 year. So please understand the funda different. Okay. So this is 2B. Good. Now, what is that? This is a very, very simple question, but you have to be very careful. I'll tell you that people will miss this question, which is an indicator of the ability of the issuer of the fixed income security to pay back his obligation. Indicator of the issuer's ability. So generally what people will try to answer is credit rating. Okay. Of course, all are very close. Okay. Okay. But please understand, credit rating is not indicator ability of the issuer to pay. It is only a rating given by an agency about its instruments based on their past performance. Okay. So which will actually to invite investors to invest in a particular company. So therefore, credit rating has a different purpose. The credit rating of fixed income securities is usually assessed by independent agencies. Ooh. So I'll tell you that generally people will select only credit rating, but I want to bring to your kind attention this particular question. So look at so I'll come to the indicator of the ability. Look at this. This is called credit quality. My God. Ability of the issuer to pay back his obligation. How strong I am. Okay. That is called credit quality. Ability is quality. Ability is quality. So it's not even rating, it's quality. It's not even credit worthiness. Of course, credit worthiness solvency will indicate the credit quality. Okay. So 3B. So please understand, rating is a different. Maybe it is some arithmetic, it is some alphabet with some plus and minus. So it's a symbol actually. Okay. So that is different. So please be careful. Now I'll now come to RBI. This is another site. I want to bring to your attention. This is here. So where is it? So where is, sorry? Commercial paper. I want to show you the. This is the FIMDA site on operational guidelines on commercial paper. So this is actually a 47-page document. So especially who can issue a commercial paper, what is the minimum net worth they must have, and who can act as all these, and especially the general guidelines. Questions will be based on the general guidelines. So this is 1 to 9 point. Please read this. And please look at this. No CP will be underwritten. So it is actually an unsecured instrument. Okay. So it will be issued at a discount to face value. And look at this. What is the minimum period? 15 days and not exceeding 1 year from the date of issue. Okay. Now this is very important. This is very, very important because a question will be based on this. Okay. Please look at this. As per RBI, commercial paper can be issued for minimum duration of 1 year, sorry, maximum duration. Okay, now this is what it's here. Not exceeding 1 year. Okay. That is for A. Okay, maximum duration. But I want to make one more observation. Okay. So what is that observation? So I will now come to this part, which I have taken from here. Commercial paper will have minimum maturity of 7 days, maximum 1 year. But however, the maturity date of 1 year of the commercial paper typically should not go beyond the date up to which credit rating of the issuer is valid. For example, if the credit rating is valid for maybe today you are issuing, okay, today's date is it is 12th of May, and the credit rating is valid for another 3 more months. So can I issue a commercial paper beyond for 1 year? I can't. So the date up to which the credit rating of the issuer is valid or 1 year, whichever is earlier. Okay, that is why this is very, very sensitive, and you have all these discussed here. Okay, so please go through this 47-page document. I only given the significant points here. Okay, good. Now as per FIMDA, the minimum duration of COD. Look at this. This is minimum duration. This is FIMDA. Okay, so FIMDA is actually, I want to make one observation here. Look at this. So what I will do is, see, you have the regulator. Regulator is RBI. You have, this is the tier 1 regulator. Tier 1 regulator is RBI. Okay. You have a tier 2 regulator. Oh, who's this tier 2 regulator? That's FIMDA. FIMDA is actually a Section 25 company. I'll just show you that. Okay. So FIMDA, this is FIMDA. FIMDA is actually, so this is the history of FIMDA. Very, very important, I will say, look at this. This is a Section 25 company, okay. It was incorporated on 1998. It is a voluntary market body for bond, money and derivatives. But who developed this? This is an association of scheduled bank, public finance institutions, primary dealers and insurance companies. So these are all the members, okay. Private sector banks, okay, nationalized bank, state bank, ICICI, HDFC, IBBI, LIC, insurance, all are there. So this is actually a tier 2 regulator. Of course, tier 3, okay, they are the financial institutions, all financial institutions, FIs. So who are all these FIs? So it will be all these banks, everybody will be there. So you have all this, everybody will be there. Okay. So this is tier 2. So FIMDA is basically they get, there are many things which RBI cannot issue directions. Now, I'll give you one interesting point. Now, look at this. This is the 2023, and every year, look at this. This is valuation of investments. And in your syllabus, I want to bring to your syllabus. Where is it, your syllabus? This is your syllabus. Look at this. In your syllabus, related FIMDA circulars. Okay. Related fixed income money market derivative association of India circular. Related. For what? For valuation of non-SLR bonds, traded bonds, non-traded bonds, non-traded bonds, not rated, FRB, target redemption bond, tax-free bond. Now you have here. See, every year they give this 31st March 2022 circular. Sorry, 31st March circular. Now this is 2022 circular, but 2023 circular is not there. It is actually there. Look at this. It is given in the front page. Sorry. It is here. Look at this. Fresh valuation of 31st March 2023. So this is up to, I've updated up to 31st March 2023. How do you value investment? Now, who will do this? Now, we are central auditors for one of the banks. Now, central auditors, of course, branch statutory auditors, central statutory auditors. Central statutory auditors, they will be doing the audit of the investments of the banks. Okay, investments of the bank. So when the investments of the banks in the balance sheet, should it be at the historical cost? Okay, where they would have invested. Of course, you have various SLR, what do you call the statutory liquid ratio. Okay. Now the statutory liquid ratio money, they will keep it in bank. No, they will invest somewhere. So where will they invest? They will invest in central government security, state government security, treasury bills. Now that will be at historical cost. That will be at book value. Now, should it be at book value or should we have to increase it to the current cost? Okay, we call it as current cost. So this is very, very critical. This is very important question. Okay, valuation unquoted SLR, traded bonds, non-traded bonds. Just now we saw everything, and this is an 18-page document. Now I want my good friends who are attending across length and breadth of the country to actually analyze this 18-page document, make it as a single page. So every batch, we are now in 17th batch. For the past 16 batches, I used to give this as an exercise. So people do this in one single page. For example, I just give you an example. Look at this. Quoted securities. Now, how this quoted security? The central government securities, state government securities. State government securities will be one line. What will be the valuation? Okay, as per prices published by FBIL. Who is FBIL? FBIL is a company. This is FBIL. Financial Benchmark India Private Limited. For example, many times when you do the valuation, you need some reference rates. For example, risk-free rate. You want to know market rate. You want to know RBI rate. You want to know debt rate. So you want to know the various market rates. So especially these are all benchmarks. This is the private limited company, but it is working in tandem with the banks and financial institutions. Look at about us. Okay. So this is basically developed by a group of financial institutions, jointly owned by FIMDA, FEDA, and IBA. Look at this, the private limited company. So below this you have FBI. Okay, FBIL is also there. So RBI is a regulator. This is a statutory body. This is Section 25 company. This is private limited. Okay. So FBIL is in between. So there are very many reference rates you have. So now if this guy says, oh, price is published by FBIL, where is it? I'll go there and I'll take it. And that is the role of a statutory auditor. These guys, they will measure it. So we have an Indian accounting standard. What is Indian accounting standard? A fair value. It may be you buy at certain financial instruments, you buy at cost, but it will be valued at fair value. And when you increase it at fair value, certain that moment, fair value which is captured at OCI, that is your reserves, certain fair value will be through P&L. Fair value through OCI, FVT OCI, FVT PL. So fair value through PL means that difference will be captured in P&L. Difference will be captured in OCI. Now the accounting part of it, we have an RBI prudential norms. Look at this. This is your accounting prudential. This is 2020. Now 2022 they gave something. I'll show you that. And this is 17. Where is it? This is sorry. RBI. This is the one. Reserve Bank. This is updated. Sorry. This is one. Master direction on classification, valuation, operation, investment portfolio of commercial banks. So this is the prudential norms. So first we will go to this 18-page document by heart. See, our entire team, we will make this, especially when the commercial, this central audit is there. This entire 18-page, they have to be thorough. This will be our reference paper. So this is for the rate. So they will multiply. This is for measurement purpose. And for accounting purpose, we will go to this. This is the classification, valuation. So valuation, again, this point will be repeated here. This is a 57-page document. Plus the prudential norms also will be there. So very interesting part here. And valuation is the significant aspect. And what is the minimum maturity of COD as per FIMDA? Now, as per FIMDA, what is for the COD? Look at this. It is here. It's here. The minimum maturity period. So the minimum maturity period is actually 15 days. I already showed you that. Okay, so where is it? It's here. Minimum maturity period is not less than 15 days. So it's already there. So just I'll give you the reference alone. You can refer it later. Okay. Now we have this come interest and X interest. But in a global scenario, global market, the come interest means including interest. Including interest, we call it as a dirty price. And excluding interest, we call it as clean price. That's it. Okay. So now answer this question. What is the price of the bond excluding interest? It is clean price. So 6B. So what is the price of including interest? So this is dirty price. So don't be bothered about these. Are all colloquial terminals. Slowly, one by one, you need to understand all this. This subject is very big. Actually, fixed income securities is a 100-mark paper. Look at this. This is an IIM professor, Dr. M. Kannadasan. He has written a book exclusively only on fixed income securities. This is the Indian book, because many of the books which is available in market on fixed income securities is a Pardesi book. So it will have a global scenario. But this is one book where he has done a tremendous research and he has deified the concepts of fixed income securities in an Indian context. But this will be it's a 100-mark paper for IIM people who actually take finance as their core and valuation and risk management as their fundamental. So it's a very, very important topic. Okay. So maybe if you wish, you want to have some reference book, you can have it. But these are all the various regulatory aspects where you need to be very clear about. Okay. Now this is the link I have given for 31st March 2022. And this is the link is for 31st March 2023. Okay. Just directly click this. It will take you to that. Okay. Now I'm taking you to the, look at this. The valuation of investment circular. This is the valuation of investment. Okay. Where is it? This is the valuation of investment circular, which is issued by FIMDA. FIMDA is Tier 2 regulator. For what? To collate guidelines, clarification issue. So the purpose is these two. The price rates for valuation of government securities and also issue guidelines at periodic interval with respect to methodology. So both. This is there in the letter first page itself. So 8C. Why do you need that circular? Because that circular gives updated information. Maybe you may say, no, why every year they have to give? Sometimes they may change. Of course, 80 to 90% of the guidelines on valuation of investments will change. And for your information, recently, the expected credit class approach is being brought out by RBI. So therefore, the next another 2 or 3 years, there will be many. This is the discussion paper which they have brought, and I'm sure RBI is slowly bringing the concept of India is 109 and expected credit loss framework for provisioning of that. So there is a necessity for do the valuation. So you need to know what is the credit risk. So credit loss measurement. So a lot of the developments are happening, and that is why there is a need to actually give a, and these valuation of investments are only with respect to, because they generally don't invest in capital markets. They only invest in what do you call it as state government, treasury bills, unquoted SLR bonds, quoted SLR bonds, okay, traded bonds, very limited. For example, beyond the SLR, if you have more liquidity, where do you will invest? You can invest in traded, non-traded bonds also. Now, non-traded bonds, how will you actually? So look at this spread matrix. You need to understand. So each one you need to understand yield curve. How do you actually measure it? Each one is actually a big chapter. Each one is a chapter. Okay. So please wait for some time. Let me go into the what do you call it as the various avatars of FIS. Okay. As per valuation investment circle, one example, treasury bill. How do you value treasury bill? Let me take here. Where is treasury bill? Treasury bill. So treasury bill will be valued at cost. That's a book value. I will tell you, 70 to 80% of the answers are carrying cost only. Only certain items will not be carrying cost. So therefore, we'll actually classify this into carrying cost item and FBIL item and like that. So only for certain items we'll go for FBIL. So other things, book value means book value. That's all. Tick, tick, tick. Okay. So treasury bill. Standalone primary dealer. For standalone primary, so this is banks. We are doing audit of banks. Standalone primary dealer, all securities available for sale and held for trading will be valued on M2M. M2M means I need to know 31st March rate. Where 31st March rate will be available? FBIL. FBIL captures everything and put it in one place. It is only a data repository. It is a data repository. Okay. Available for everybody. It is free of cost. They don't charge anything. You and I also can go there. Okay. Good. So very interesting. Password is carrying cost. So 9A. As per evaluation investment circular, blah blah blah. All central government securities which qualify for SLR. Okay. Now come here. Central government securities which qualify for SLR. So how do you value? Okay. As well as which do not qualify for SLR. So there are certain central government securities which you invest, it will be included in statutory liquid ratio. Certain central government securities which will not be included in statutory liquid ratio. Both will be valued as per the prices published by FBIL. FBIL is again coming under FIMDA only. FIMDA coming under RBI. So the entire whip is with RBI. Please understand. Okay. Everything RBI cannot do. So that is why it has delegated. FBIL. So that will be price published by RBI. No. FIMDA. No. Central government. FBI. Financial Benchmark India Private Limited. And very, very important. Okay. Now commercial paper. Certificate of deposit. Tenor less than 1 year. So I'll come to this. For example, commercial paper. Look at commercial paper. Look at commercial. Commercial paper and certificate of deposits. Both, okay, will be valid at carrying cost. I told you, no. So treasury bill, CP, CD, all carrying cost. So in my office, I'll give this 18 page. So I will ask them to put a table in Excel sheet. What is the basis? What is the base of value? We say base of value, basis, no? So the basis of valuation, this is the carrying cost. So this carrying cost is the base. Okay. So it's very, very, very interesting. Okay. So this circular has to be read as many times. Of course, day and night that audit will be happening. Now my team is actually sitting in doing all this work there. So this is a very important document which they have made. So fundamentally, the team will be thorough with this circular. Okay. So good. So this is carrying cost. So 11A. So the treasury bill is also carrying cost, CP carrying cost, CD carrying cost. So there is no concept called fair value here. Okay. Of course, fair value is going to come. Okay. Now, do you have a fair value somewhere here? Look at this. Fair value. No fair value. Oh my God. So RBI doesn't, they don't hear a term called fair value. No, they will be deaf to fair value. Okay. Very interesting. Good. Right. So now, valuation of SLR, non-SLR bonds shall be made as per valuation of investment circle, issued and updated yearly by SLR and non-SLR bonds. Okay. So this is SLR and non-SLR bonds. Let me take you to SLR quoted, valuation of unquoted non-SLR. SLR. Look at this. Okay. So this is bonds having. So what is this? SLR and non-SLR bonds as issued and updated yearly by. Okay. This is a general question. Okay. Now, valuation of SLR, non-SLR bonds shall be made as per the valuation of investment circular. Now, this question is, who issues this valuation of investment circular? So you need not go, what is the method? Who issues it? Issued and updated. Is it by RBI? Is it by ministry? Is it by SEBI? No, it is FIMDA. Please understand this question. Okay. So far, method was asked. Here, who is actually issuing and updating? So in that method will be given where you have to refer, everything will be there. So quite a very interesting question. So you have to be very alert, logically clear. Okay. So now I'll come for these are all some questions. Only I can do only if this bond question I do it. Now all of you look at this 27th question. I'm going to do a bond question. So we have a arithmetic here. So what I will do, I will delete all this stuff. Okay. So let me delete all this. So look at this, guys. So what is your face value? For the following data, calculate yield till maturity, duration, modified duration. What is duration? What is modified duration? I'll explain. So this is face value 100. Price of the bond means you buy the bond, face value 100 at 92 rupees. You pay 92 and get this bond. This is a discount. Okay. Coupon is 11%. 11%. That means 11% of 100. This face value has only there is a Tamil movie where one person will be only eating mixer. That person is actually has become very famous in the Indian cinema history. Without speaking a dialogue, he has become very famous. Like that, face value is like that person. Only it is a mixer item. So this 11% will be only multiplied on 100. So it will be 11. Tenor is 9 years. That means 9 years it will be mature. So 9th year it will be repaid. Now what is the redemption price? So at the end of 9th year, 112 will be paid. 100 rupee bond repaid. And now you need to find YTM. Yield means return. Now I have to find for all the 9 years what is the yield. Now what is the cash flow? 11% of 100. So this is 11 rupees. So 11 rupees will be paid for 9 years. Now what is this word called? Yield till maturity. Till maturity. Till maturity. Okay. Now the same question I will also do it for yield to call also. Now what is yield to call? I'll explain. Okay. Yield to maturity, yield to call, both are different. Okay. Now come to this question. Now we have 11. But at the end of 9th year, you will get the interest as well as the redemption amount 112. So this is what the money you will get. So answer is 211 rupees you get for investment of 92. 92 invest, you get 211. So therefore there is a return. So what is the return? Let me take just 10% as a what do you call it, as a trial and error method. Trial and error method. So I will find the present value of this 10%. Yes. So I'll take the PV factor, multiply the 11 into this, add this. So now you get 110.85. So if the yield is 10%, it is 110.85. If the yield is zero, it is 211. Value means what? Price. Price is 211. That means you invest 211, you get 211. But you invest 92. For example, if it is 20%, 20% means price is 66. 20% means price is 66.05. Now, a 10% yield, you have to invest 110 and get 211. At 20% return, you invest 66 rupees and get 211, then the yield is 20%. Now, you invest 92. So naturally, your return on investment is between 10 and 20. So how will you find this? So I will use the goal seek here. In goal seek, I'll fix this value as 92 by changing this value. It changes. So it is 13.3461. So 13.34 is your yield. This is your yield. That means your return. This is your yield. So you invest 92, you get 11 and 112, 211. So at 13.34, this is otherwise called IRR. YTM, IRR, return on investment, ante okate. All one and the same. You say Eluguntalavada, Venkatramana, okay, Devuda, Govinda, Krishna, Gopala, all one and the same. Okay, good. So now this is your, yield to maturity, 13.35, 27A is B. Okay. So now I'll come to this yield curve. Yield curve also I'll explain. What is the yield curve? How do you prepare yield curve? What is the benefit of an yield curve? Now, when you are actually in the dealing room, what is dealing room means? See, today I just showed you this. What is this? FBIL, no? That's right. That is FBIL. BSc. And look at this. You have so many things. This bill, that bill, security code, all this maturity date, LTP, coupon rate. These are all zero coupon. Okay. maybe this 7.26 coupon is there, maturity date is there, yield is there. Look at this yield. Yield is there. Now weighted average price is there. This turnover is actually the volume. Now by looking at that, which one you will buy? How will you know? Next moment you should be in a position to say, okay, I have a GOI bond here, Maharashtra bond is there, 3-0 T-bill is there. So those are all, why this is called zero coupon means only maturity money will be paid. So in between there is no coupon. Okay. So it is opening you invest, closing it will be mature. That is why coupon zero. Doesn't mean that they don't pay any interest. Please understand. Okay. Zero coupon means at the end it will be paid. Now, which is a better investment? How will you do it? That is why this yield curve will actually help you to actually do it. How to prepare yield curve? What is the interpretation of that? So let us understand that step by step. Now, what is the next question? What is the duration of the bond? Duration of the bond, I'll tell you. Now look at this. You invest 92, you get 211. That means there is a payback period. And in financial management, you would have also done a concept called discounted payback period. So what is this discount? Because it's a discounted price. So what is the discounted payback period? Wow. So this 9.7 you get out of investment 92. So that means 10.55% of your investment you get in first year. Similarly, you get for second year 9.31%, third year. Okay, and this is what you get. Oh, wow. So, where is it? So, sorry, why it is not coming? So, 100%. You got your entire money, 92 you got. Now, what is the weighted average in terms of price, in terms of time? This is within 1 year. So, take the weighted average time. 6.0816 years. This is called duration. 6.08 years. Duration means payback period. You can even call this as payback period. Actually, it is a discounted payback. Discounted payback. Okay. I'll come to this a little later. So now, what is this discounted payback? Sorry, payback period is, duration is 6.08. 6.08 years. So 27B question is C's answer. Okay, good. Now, what is modified duration? Modified duration is the volatility. Now, please look at this. For 10% increase in yield, the decrease in value. Wow. For 3.34% increase in yield, you want the return more. The return is more. Okay, the return is more, price should be less. If the return is less, price will be more. You pay more price, then the yield is less. Okay, lesser the price, more the discount is given, yield is more. 20% return, discount 66 rupees. Now there is a volatility. That means for every 1% increase in yield, what is the percentage of increase in value? Now look at this question. This is a question. We call it as bond. What do you call it as bond rules? We call it as bond. Look at this. Increase in yield means decrease in price. Increase in yield, decrease in duration. Decrease in yield, increase in price. Decrease in yield, increase in duration. Now, what is duration? So payback period. Yield decreases means return decreases. Then your payback period will be more. Logic. This is logic. This dabba is logic. Now, if the coupon rate of the bond is it's lesser. Below means lesser. Okay. So coupon rate means your what do you call it as interest rate. Okay. The yield to maturity price of the bond should be okay. So if the coupon rate now look at this coupon rate. What is coupon rate? 11%. Okay. Now what is your yield? 13%. If the coupon rate is coupon rate yield to maturity. Now, what is your yield here? 13. Coupon is below. If yield is above coupon, if the coupon is above the yield, coupon is below the yield, price of the bond should be. Now look at this. If coupon is below yield, price is below face value, 92. The coupon is below the yield, price will be below the par. So below and below. Similarly, reverse also will happen. if the coupon is above the yield, price of the bond will be above the par value. That means at the premium you have to pay. Yield is less, cost is more. So that is why it is called very important question. So unless another you understand this practically, you know what is the implication. Govinda, this is gone. Okay, 18 is C and D. Okay, C also will come, D also will come. Okay, please be careful. Now come to this question. Now this is another question. If YTM increases, price decreases. Present value decreases. Present value goes down. Okay, so 19A. Same question. Okay, the same dabba you can actually answer all this. Similarly, yield decreases. Yield decreases. That means return is less. Duration will be more. Duration will increase. 20A. Yield decreases. Look at this. Yield decreases, then duration will increase. And the duration will be, if the yield of a bond has decreased from 8 to 7, yield decreases. Sorry, look at this. Yield decreases, duration increases. Okay, so very important. Okay, so that means lesser the yield, return is less, your payback period will be more. Logic is same. So yield to maturity decreased, then the duration will increase. 20A. Careful, guys. Very careful. Okay. Understand the logic. Okay. Otherwise, Govinda. Now come to this question. Now duration is over. Now what is modified duration? I'm not going to do this modified. Modified duration is volatility. Okay. It's very simple. Duration by 1 plus YTM. Look at this. And this duration is called modified. Macaulay duration. Macaulay is the name of the guy who actually founded this model called duration. Okay. So that is what it's called Macaulay duration by 1 plus YTM. Sometimes this duration will not be in years. It will be in semi-annum, it will be in months. Then YTM also you have to divide like that. So that is why there is a difference in formula. So what we will do, we have this duration is 6.08 divided by 1 plus YTM. YTM is 13.3461. So 5.3655 times. So what is the meaning of this 5 For every 1% increase in yield, there will be 5.37% decrease in value. Okay. Or for every 1% decrease in yield, there will be 5.37% increase in value. Okay. 5.37 times. So 27 CB. Good. Now yield to call. Very important. What is yield to call? See, we have this option. We have an option. Now, yesterday the topic I'm going to integrate with today's topic. Okay. Yesterday's topic I'm going to integrate with today's topic. Now, please look at the concept here. Now, I have taken money. I have issued a bond. I have taken money. I'm going to use that money for my business. And I have assured that 9th year I will repay the bond. Why I should carry the burden of liability for 9 years in my books of accounts? These are all liability, no? And when I have cash surplus, why should I keep cash surplus and I will wait for payment 9th year? I will have an option. Now the option is given to two people. One, if the option is with the issuer, for example, at the end of 5th year, at the end of 4th year, option is with the issuer. He will say, all of you, come on, I want to pay you. So that means it is called option exercised to repay the bond. That means I am going to buy the bond. Option to buy. That means option to buy means call option. Call option will be with the issuer. Now come to the investor. Investor will have the option. No. Who are you to give the option? Yeah, when I need money, I will come to you and exercise. I want redeem. You give me the money. So then, this is the option to sell. The option to sell is with the investor. Then the option to sell means put option. Please understand, put option. So now look at this question. What is the yield to call? If the call option is the issuer. And the bond has a login period of 4 years. So till 4 years he cannot call. End of the 4th year he will call. Come, everybody come. So, and called at the end of 5th year. So 4 year login period and 5th year, after 4 years he can call, but he is calling at 5th year end. That means What is the yield? Will the yield will be same? Yield will be greater than 13.34, yield will be lesser than 13.34. That is the question. Okay, we are going to discuss that. Now, this is 11 rupees. 11. Now, this will be 11 plus, I'll repay 112. So, instead of 211, you get only 167 rupees. You invest 92. 9 years you wait, you will get 211. 5 years you wait, you get 167. Now, will the yield will be same 13.34% or greater than 13.34% or lesser than 13.34%? Very, very important concept. This is called YTC. Okay, YTC. Okay, these are also. So there are numbers below 13.34, numbers above 13.34 also there. Oh. And 13.34 I have not given an option. So therefore not equal. Huh? So let us see. So let us see same 10%. So 1 divided by 1 plus R. Of course, there are shortcuts methods are there, but I'm giving you the entire explanation. Otherwise, I can do a shortcut, but you should not feel it otherwise. So that is why I'm doing it in a very detailed manner. So this is your present value. And again, I'll apply the goal seek and I'll put 92 here and I'll change this. So, my God, 15.1699. So yield to call is 15.17. 15.17. So 27 DD. Now, I want to prepare the yield curve. Okay, this yield curve is otherwise called effective duration. Oh, just now we saw duration, modified duration. Duration means Macaulay duration. Modified duration means volatility. Now effective duration. I am going to see the yield curve. How to calculate yield curve? Okay, this is the sensitivity of the bond price. By looking at the yield curve, you can actually decide what to do. Now look at various yield curves. Normal, flat. Now let us see how this yield curve will be calculated. Now let us see. Settlement date. Today's date is 12th May 2023. Now what is maturity date? 9 years. 12th May 24, 25, 26, 27, 28, 29, 30, 31, 32. 2030. Okay. Now yield to call, if yield is it is done. So maturity date will be 12th May 2024. 12th May 2025. Now I'll take this. 12th May 2023. This will be, so 5 years means it is 12th May 2028. 5 years means. Now I'll do this is effective duration. So now duration, that is Macaulay duration, and modified duration, effective duration. All three we are done. Okay. Now look at this. 1, 2, 3, 4. So let us do the yield. So what is settlement date? This is settlement date. What is maturity date? This is maturity date. Okay. What is your interest rate? Coupon is 11. So what is your price? 92. What is the redemption? 112. Okay. Frequency is annual. So 1. Wow, 13.34. So look at this. This I am using a not this I am using a function. This is function. This I am using a formula. This is using a formula. I did all this formula. No, this is formula. Using formula and goal seek and all, I got 13.34. Same 13.34 I'm getting. Okay. So now what I will do, I will freeze this. I'll also freeze the maturity. Not maturity, I'll freeze it because maturity I will not freeze it. What is B? This is also I'll freeze it. And I'll also freeze B2. I'll also freeze B5. What is B5? B5 is redemption. So now look at this question. Okay. Look at this, guys. So I will get the yield till first year. Wow. Look at 50 year, 15.1699. 15.1699. Same. So this is yield for yield till maturity. This is called yield till maturity. This is YTM. These are all YTC. This is YTC. If it is called, it's 1. This is YTC2. This is YTC3, YTC4. This is YTC 3, YTC 4, YTC 5, YTC 6, YTC 7th year, YTC 8th year until maturity. Okay. Now I'm going to do the yield curve. This is yield curve. So take this, draw, insert. Okay. I will actually draw the chart. This is the chart. Wow, this is your yield curve. Look at this chart here. This is inverted yield curve. This is a normal one. Inverted. Now, what is this upward curve, downward curve? Upward, this is a downward curve. When downward curve will be there, price is at discount, redemption is at premium. Now, if price is at premium, redemption is at discount, the curve will be like this. Now, flat yield, you actually try, price is also 100, redemption is 100, coupon is 10, 11%, something like that. You try different, and see the change in this curve. Curve will change. And the next step reading is, if the curve is like this, what is the implications of that? Okay. So that is the next one. So this is effective duration. What is the provision in the bond that gives either the issuer or the holder right to take action in future? That is called embedded option. Look at this. Bond plus embedded option is bond with option. This is called embedded option. Now the example what I did, YTC or YTP, yield to put, yield to call. Yield to put is for the investor. Yield to call is for the issuer. Okay, so it is called embedded option. This is called embedded option. So 29B. Actually, you have various avatars of option. Look at this. How many avatars are there? 23 types of bonds. Remember, all from this exam questions is possible. Convertible bond, perpetual bond, zero coupon bond, plain vanilla bond. Now, recently, the social stock exchange has introduced one more bond, ZC, ZP. Okay, ZC, ZP. And mind it, guys, I'm going to start another new batch, and a lot of registrations are already done with respect to the social auditor certification exam. I'll be doing more. This is a 1 week session I'm doing from next Monday onwards. And there is also good response for the valuation pinnacle also. So thank you very much for the kind of support you have been extending quite now and then. Tomorrow's session, actually I'll be in Thiruvananthapuram tomorrow for this morning session. But those who wish to actually form part of this, there is an exclusive registration for this. There's a link here, and this link I will actually share it in the blog today. Please go to blog and then register for tomorrow. Okay. So the link will be only available in the blog. Okay. Or you can be in touch with the coordinator. He will also share the blog link. Okay. So guys, one more last question I will just do here before I close for today. Please look at this question. Very, very interesting question. Like, for example, sovereign bond. Look at this. The minimum credit rating for commercial paper, as per rating symbol and definition prescribed by SEBI. Wow. What is the minimum credit rating required? This is an exam question actually. Okay. That means this is the rating should be above this one. Okay. So is it A1 or A2, B or B, BB and all? It will not be possible. Minimum is A2, above is A1 and above that. So it is 37 is A2. Very important question, is an exam question. Okay. So guys, this is the minimum credit rating. Exam point is an exam question. That is why I'm just sharing this point to you. So guys, I must appreciate each and everyone's patience here. And let us now listen to a few of the participants. So shall we listen to Deepak Verma, and we'll also listen to Kalyan Mitra. We'll also listen to Chelapa, Manoj Joseph. We'll also listen to Manoj Joseph. And we'll also listen to Girish Arvind Satha. I'm unmuted, you can, and GM Reddy, you can also unmute and share your thoughts. Good morning. Good morning. Go ahead. Yes, Girish. Om Yashwant. Binoy, you can also share your thoughts. Banu Murthy, good morning. Morning.
Hello, good morning, sir.
Yes, kindly introduce yourself.
Yeah, this is GM Reddy. I am from Hyderabad, practicing chartered accountant. My question is, which is the best material to pass this exam, sir?
No, they just give you a reflection, sir. The general questions will take it offline. So, what is your reflections about this 4 or 5 day session?
It's an excellent session, sir. I didn't expect this much of information was covered in these 5 days only. I'm very happy with this, sir.
Very good, very good. So, best wishes. So, Pungodai, Arun Balamurugan, Preeti, good morning.
Good morning. This is Chalapa. Yeah. This is a very nice program. Raju, it's really nice. Actually, you are doing a very good jobs. I want to attend physical program also if you have organized. So,
Where are you from, Chalapa?
I'm from Chennai only.
Chennai.
I'm in Madipakam. Yeah.
Very good.
See, actually, I was in the profession. I was planning to go for a practice now. I'm a cost accountant. So planning to go for a practice, and so I want to do either this or valuation exams. Both also I'm trying. I mean valuation as well as the insolvency also. So I am trying for that. So
best of luck.
Very nice program. Really very good. Thank you.
Now let us listen to Sarika Jain. Good morning, Sarika.
Good morning, sir. It's a nice program. You are continuing with you, and I'm learning a lot from you. And thanks for making time for us.
Very good. Very good.
Good morning, Dr. Raju.
Very good morning.
It's Manoj from Kochi. I'm a practicing chartered accountant, and I've been following your fast track webinars for few things. And I missed the first day, but it's amazing the 1 hour, the amount of knowledge you pack in that 1 hour, and with your sort of anecdotes and examples, very helpful because it stays in your memory. Thank you very much.
Very good. Best wishes, Manoj.
Thank you.
Good morning. Am I audible?
Yeah.
Good morning, GK sir. It's been a pleasure to attend your sessions, and valuation is something that I can say you are the best reference point when it comes to knowing each and every concept of valuation. So it's been a pleasure to attend all the days of your sessions. Just one question, sir. When it comes to options valuation, where can we practice questions? Because it's so complex, as you said, so many reference we need to have for circulars and a lot of formulas. So I know it's a very difficult question to ask, but then from a person who's giving an exam, how can he practice
What is your
questions?
academic background?
I'm a practicing cost accountant from Mumbai. I've done my CIMA and ACCA from UK.
We have very good textbooks and the study materials of CIMA study material, a final study material. Everything gives excellent ground to actually get practice on fundamentals.
Thank you. Thank you so much.
Dr. Giridharan, good morning.
Morning, sir.
Good morning, sir.
Sir, all these 5 sessions, while you are evaluating the valuation of bond securities, you have become a 007 James Bond. Congratulations to you. And I would say on behalf of all the participants, irrespective of the place where they are staying, they took all the time to attend. And this is the greatest gratitude that the fraternity has given to you. And definitely we got the yield curve at the highest. Kudos to you, sir. Kudos to you.
Thank you. Thank you very much. Jitendra Bhai.
Yes, sir. Jitendra from Chennai. Good morning, sir.
Good morning.
Today's session was very excellent. In fact, many of the concepts which are there, it's not there in the material, nor we were taught in the training. So a lot of insights, and definitely it will help us to get more insight, and will be like helping us for the exam. Thank you so much, sir.
Very good. Very good. Girish Arvind Satal. Good morning. Good morning, Girish. Good. So Let us now listen to Sampath Kumarji for his closing remarks.
Dr. Raju and my dear friends, the power-packed program of 5 days with so much of detailed explanation of concepts and implications involved from the perspective of examination, every time touching the syllabus, where it is, why you are covering. And I am personally the beneficiary of attending your classes couple of years back and completing the evaluation course and examination and practicing that. Still, I wish to regularly attend because every time I attend, different perspective emerges for it. Learning is a continuous process. I also specifically vividly remember the pinnacle classes where you touch upon the problems, more of problems, which is the fundamental basis for cracking the exam. My dear friends, you are nicely stated about your reflections and also the testimonials in all these 5 days to Dr. Raju. And I wish everybody should be a registered valuer and crack this exam. The key or important aspect to that is joining for this pinnacle course of 2 days, tomorrow night and day after tomorrow or whatever the 2 days. It's a paid program. It is worth paying to acquire this qualification is my personal view, which I am the beneficiary. I was the beneficiary. I continue to do valuations and other things. Thank you, Dr. Raju and my dear friends.